Just got back from Philadelphia and I'm on my way to a client meeting to help them figure out the answer to a question that you might be struggling with. And that is, what do you do when your long-term care premiums go through the roof? We'll see if we can help you figure out that question. It's a hard one. So here's the issue they're dealing with. They've owned this long-term care insurance policy for, wow, probably 14 years now, long before I even met them. And they just got notice that the premiums for the policy are going to increase pretty substantially. And now that they're in their 70s, it's like, how do you continue to pay for a policy that, one, you've never used and you poured money into for well over a decade? And you're living on a limited budget now. You don't necessarily want to keep dishing out more and more money for insurance you may not need. It really puts them in a hard place. That's the thing with long-term care policies. The insurance companies have systematically, especially over the last few years, been increasing premiums, especially on the older policies. Got to figure out where I'm going here. Because the claims experience that they're getting from these policies is much higher than they had anticipated. You have advances in medication, advances in healthcare, increased requests for benefits from clients that are all of a sudden they're saying, hey, we priced these policies and the assumptions we used to set the price was pretty much all wrong. And now they're finding themselves having to go back to the policyholders and increase premiums once, twice, 3 times, and sometimes by rates as much as 40, 50. I think I've even seen like a 60% increase in price. Ooh, I gotta turn around here. I think I missed my turn. So that puts my clients and maybe you in a situation of, what do I do with this policy? Is this the end of it? Or is this just the beginning of throwing more money towards something I may never use? That's a difficult question. So we're going to try to solve it for these guys, but we're also going to give you a framework to address it for yourself coming up. Now I got to get to this meeting. Where am I going? All right, I'm back in the home base after my meeting with my client. You know, I probably shouldn't be talking to you while I'm driving. That's probably not safe. Anyway, okay, so here's the situation. The client's had this policy for approximately 13 years. I'm changing some of the facts to help protect confidentiality. And the premiums are roughly $6,000 a year. So over the last 13 years, they put in roughly $78,000 into this long-term care policy. And they just got notice that the insurance company has filed with the state, because for an insurance company to raise a premium, they have to get approval from the State Board of Insurance. And they're asking, the insurance company is asking for a, on average, 77% increase in premiums. Oh! Which is going to affect about 75% of the policies they have out there, the policyholders, people like you. So this couple who has been poured about 80 grand into this policy now is facing the prospect, so it's got to be approved, that their premium is going to go from $6,000 a month to $10,000 a month for the same insurance. But when you're in your 70s and 80s, and you know you can't get any other insurance, most likely if you went through underwriting, man, you're stuck between a rock and a hard place, right? And it's a pretty nice policy. They got, you know, it's joint life, it's got an inflation rider, all these things, and basically the insurance company just totally mispriced it. So what do they do? What do you do? But here are the basic options you have when you face something like this. Number one, you just suck it up and you pay it. Right? They say that insurance is it's really expensive if you don't need it, but if you need it, it's the cheapest thing you could ever get, right? So they're going to have to, one, either buck it up, pay the insurance, because they're not probably getting anything equivalent in today's, to protect against one of them or both of them dealing with a long-term care event that might really hurt them financially. And the interesting thing about when those things happen, yeah, it hurts the couple financially when you're married, but a lot of times it can devastate the financials for the surviving spouse, right? So you're facing that when you're trying to make the decision, do you keep it or do you not keep it? Number two, you can just drop it, right? You can just say, you know what, we've poured so much money into this. We don't know if there's going to be more premium increases in the future as they catch up. We just drop it and self-insure, which is going to save them 10 grand a year unless they have a big event, right? And that's the risk. Those are two big options that are very extreme outcomes, right? Well, another option could be you could work with the insurance company to say, hey, I want to pay the same premium, but just lower the benefits that you're promising me. That's an option that you have a lot of times, is say, I can't afford it, so let's just lower the daily benefit amount or whatever other features are in there. And things like inflation, you can cap inflation or take that off, all those type of things. So you can work with the insurance companies a lot of times to say, hey, I can't afford it. So how much can I get for this and not have to go through the underwriting? That is an option, but it still is a pretty bitter pill to swallow after you've already paid faithfully year after year. My worry is that we ain't seen nothing yet. Because even from a claims experience, we're just at the beginning of baby boomers tapping these kind of long-term care policies, because the bulk of them aren't that old enough to really get to that sweet spot of maybe needing these things. So what does the future hold if you are considering buying a policy like this today, or you have one and they haven't come knocking on your door yet to increase your premiums? They might. Do you keep pouring money into these things? It's hard to know. And I have no answer as of now. I am very wary of these traditional policies for all of these reasons. So what is a framework to decide if you're facing this skyrocketing in the long-term care insurance premiums that you're looking at? Or if you're earlier in retirement and you've bought one of these policies and you're evaluating, do I really want to sink a ton of money into these things, right? So I think one thing you can do is, if you have a coordinated plan for the kind of lifestyle that you want to live, is stress testing that plan against a potential long-term care event later in life. So if you're sitting there and you're 63, and we can model this, we model it all the time in our practice of, okay, what happens if I got one of you at age 82 go into a long-term care facility for 3 years and it's going to cost, let's say, $80,000 a year. Let's model that and see how it impacts the entire plan. 3 years is about an average time that, a length of time in one of those kind of facilities. And then you can model what happens if one of us has a long-term care event. an Alzheimer's event, that the really big one that could be a decade, and see how that impacts the plan. Because it could be, and I find sometimes it is this way, it's possible you could self-insure this or buy a policy that's not the primo to totally transfer the insurance, but to buy something that will help but not totally replace the impact of something like that happening. There is no easy solution for this. I don't have a solution to really offer you here. I just have some words of caution of what you're facing as you're evaluating these policies. Now, on the podcast, we're going to do an entire month on long-term care risks and ways to insure against it later this year. So look forward to that if you listen to the Retirement Answer Man podcast, because there are some new, unique products coming out that might be a little bit more friendly, so you don't get yourself in a hard place, rocking a hard place when you're in your 70s or 80s.